All right, today's webinar is going to be on loan guarantors for apartment syndicators. And you can see that right here on your screen, loan guarantors for apartment syndicators. And today we are going to be covering this topic because there's a lot of people that, are getting started in multifamily and trying to get going. And, they might not have certain things that they need to be able to be their own loan guarantor to be able to take down some of the larger assets that they're looking at acquiring. And so today we're going to go over this, what is a loan guarantor? What is the role of loan guarantors on a deal? How do you find one of those loan guarantors? How do you select the right loan guarantor for your deal? And also how to compensate a loan guarantor as well. And as usual, we'll include a lot of other different things in here as well. And for those of you who missed the webinar last week, we did one with Dugan Kelly. That's why his email is showing up here in that box. So, but anyway, so we're going to be talking a lot about these things. And for those of you who are on here live, how many of you are really excited about the webinar today? Because there's a lot of stuff for us to cover. Just raise your hand there, kind of raise your hand. Let me know that you're participating. That's awesome. That's awesome. Well, what I want for you to do is just take a lot of good notes, because I don't do PowerPoints, as most of you know, if you've joined me on these webinars. I don't have the time to put those together, but I really still want to provide a lot of this information for you. And so we'll basically go through each one of these questions and answer them for you in a lot of detail. And then for those of you who are joining us live, if you have questions, you can type them into the chat box, and I will try to field as many of those questions as possible as we go throughout the webinar today. So target time frame for the webinar is going to be about 20 to 25 minutes. That's usually where I try to keep it. And then we're going to dive deep into this. So before I get started in the content, there's two things that I want to mention to you. So first off, I'm Dan Handford. For those of you who don't know who I am, I'm one of the managing partners of this group called PassiveInvesting.com. You can easily go to this website, PassiveInvesting.com, to find out more information about what we do. For those of you who are on live, I will type into the chat box the link so you can go straight to this page. You can find out anything about our team. There's also bio videos on each one of our team members here, as well as our properties that we have acquired. And then we're also in the process of building out a knowledge center here, which we're really excited about. We're going to be providing a lot of good content on there for everybody to be aware of, kind of multifamily in general. And if you're interested in joining our Passive Investor Club on one of our next deals, you can go to this little button at the top right. It says Join Passive Investing Club. You can click on that, and it will bring you to the page where you can actually fill out your information. And then when you fill this out, we'll actually jump on a one-on-one call. I'll actually jump on a one-on-one phone call with you to discuss your investment goals and make sure we're a good fit. So that's enough about that. But I also wanted to finally mention about the MFIN Premium membership. If you're interested in that and taking a look at it, it's a monthly membership program. It's only $99 a month right now. It will be going up, but you can go to mfinpremium.com to check that out. And again, for those of you who are on live, I will type that into the box, mfinpremium.com, for you to be able to take a look at that. All right, so let's dive deep here into loan guarantors. Give me just one quick second. I'm going to step away just so that I can close my door real quick. All right, I'm back. Sorry about that. I know sometimes the sound can sometimes be distracting, so I wanted to make sure that I closed that so I was not distracted. So I apologize. So first thing I want to talk about is what is a loan guarantor? There's a lot of, misnomers out there, and maybe not misnomers, but more, different terms that kind of mean the same thing, right? And so, a loan guarantor can be somebody who is what is called a sponsor on a property. It can also be somebody who is considered a key principal, because without them, the key, they could not enter into that loan or that particular property. And so they'd be considered that key principal. And so there's lots of different names for these: balance sheet guarantor, loan guarantor, key principal, sponsor. A lot of those terms are synonymous in what they're actually, portraying. And so it's important to understand that. So when you're talking to other people, you kind of know what they're talking about. Now, there are also people that will talk about a sponsor as just like the main operator on a property, right? And so you have to, sometimes when you talk about somebody being a sponsor, you want to make sure that you kind of clarify, are they the lead sponsor and they're actually the loan guarantor on the property, or are they the operator on the property? And so a loan guarantor is for today's webinar, we're just going to call them loan guarantors to make it simple. So as a loan guarantor, there are three different things that you have to have and meet in order to qualify to be able to sign on the debt. And so one of those things is actually a net worth. So you have to have net worth of the loan balance in order to be able to sign on the debt. Now, that doesn't mean you have to have there's just one person on your team that has to meet this net worth requirement. It can be a total aggregate of all of the people on your partnership that actually meet that net worth requirement. But every person who is going to be a loan guarantor has to be written with the loan, and they are required to go through those different checks. And as far as they do background checks and credit checks, and making sure that you actually have the net worth and liquidity to be able to sign on these loans. And so, but the three requirements is you have to have the net worth of the loan balance. And then the second requirement is that you have to have at least 10% liquidity not in the property, but 10% liquidity of the loan balance available in liquid assets. And so to give you a quick example of those two things, if we're acquiring a property that is, say, $12 million, and the debt on that property is $10 million, then you have to have an aggregate total of net worth on your team with these loan guarantors of $10 million. And then you have to have 10% liquidity, which means you have to have 10% of that $10 million available in liquid assets. So you have to have at least $1 million in cash in the bank, or stocks and bonds or mutuals. It cannot include self-directed accounts as far as IRAs or 401ks or any type of retirement accounts. It has to be easily accessible funds that would qualify for that liquidity. It cannot be any money caught up, anywhere that cannot be easily accessed. And so there's obviously some strategies on try to, still invest that money, whether it be in stocks or mutuals or ETFs or indexes or something like that. You can still invest it, but it has to be easily accessible. And so you have to provide that verification and that proof to the lender with that loan guarantor. So before I move forward, are there any questions about that particular topic? Because there's two, I mentioned two of the three things, and I'll cover the third one in just a minute. But if you have any questions as we're going throughout, just type them in and I'll try to address them as we go throughout. The third thing that is required with to be able to be a loan guarantor is you have to have experience. And there's two kind of levels of experience that they're looking for. Number one, which is the top thing, is they want to see, do you have some form of experience in multifamily in general? And one of the things that I found when I was starting to do loan guarantor work is that I was also able to leverage my background and experience in actually managing large budgets with the businesses that I own. And so they use that as additional level of experience to kind of give them that more confidence in allowing me to be that loan guarantor. And so there are three main things. Again, number one, you have to have net worth of the loan balance. And this particular net worth qualification or classification, it can include the net worth can include your primary residence. So you are able to do that with this. When it comes to being an accredited investor, it's a little bit of a different story. So in order to be an accredited investor, you have to have at least $1 million of net worth, not including your primary residence. And then you also have, or you have to have 200,000 if you're single, or 300,000 if you're married, of income for the last 2 years, and have a reasonable expectation for it to continue in the next year. And so with this requirement, though, that net worth can also, it does allow you to have the primary residence included in that. Okay. So net worth of the loan balance, liquidity, 10% of the loan balance. And then the third one is experience. I have a couple questions in here. So let me address a couple of these questions before we move forward. First question is coming from Scott. Any idea if HELOC funds will count towards the 10% of the loan balance? And the answer to that question is that if you have a HELOC, which is that home equity line of credit, so you have a lot of equity built up into your house, and you want to have access to that, in order to provide that as proof for your liquidity, they usually will accept. Every lender's a little bit different, but so far we've actually done the same thing, Scott, is you can actually have that HELOC in place. Of course, it just stays on the property until you actually need to show the verification. You pull it out at the end of the month before the statement hits, put that money off the HELOC into a savings account, show that as liquidity. And yes, you can use that as liquidity. But you just got to keep in mind that if you do that, then your personal financial statement will actually be updated. So your net worth would actually go down in the commensurate amount. So as long as you have a high enough net worth, then it wouldn't really have that much of an impact depending on how much you're pulling off. But you can use a home equity line of credit. And the way I kind of like to use it sometimes is I'll pull it off at the end of the month, stick it in a savings account. adjust my PFS to reduce my net worth, which is fairly insignificant when you factor in that small amount that I'm pulling off. But then it allows me to show that higher liquidity. And I put it in there until the bank statement prints out for that month, and I'll just take it and pay it back right back onto the HELOC. So I'm only paying interest on it for maybe like 4 or 5 days while I'm showing that proof of liquidity. So that is an option that you have. So great question there, Scott. The next question here is from John. He's asking, talk about the equity levels for all those that will be loan guarantors. And I think, John, you're referring to one of the questions we have in here about maybe how to compensate a loan guarantor. So we'll cover that a little bit later, unless you wanted to give me a little more questions about what you're talking about as far as that is concerned, John. But I think that's kind of what you're getting at, is the compensation, or how you actually pay a loan guarantor to be on the property. Another good question here is coming in from Charlie. Are the requirements for net worth and liquidity one-time requirements tested at the time the loan is made, or are these requirements ongoing on an annual basis during the term of the loan? And the latter is actually what it is, Charlie. So you have to have the net worth and liquidity at the time that you're signing the loan, and then they also do verifications and checks throughout the year. So some lenders will do it on a quarterly or a bi-yearly basis, and some of them do it once a year. But they'll usually have you do that verification throughout the entire duration of that loan. The next question here is, should a loan guarantor, this is coming in from Brian, should a loan guarantor for a multifamily asset be an equity partner in the deal? So equity partner, meaning, I'm assuming you're saying an LP partner. It does not necessarily have to be, but most lenders will require the loan guarantor to also have some form of skin in the game. And so they'll usually be mostly the time, Fannie Mae and Freddie Mac are a little more sticklers about this. They want to see that the loan guarantors have some form of skin in the game, because they want to make sure that they have that in order to protect themselves a little bit further down the road as well. So great questions there. Hopefully I answered them in detail in that as well. Let's see, do all of those that have more than 20% equity need to be on the loan as a guarantor? So that's coming in from John, to kind of clarifying it from the equity levels. And the answer to that question is typically yes. And what John is saying is that anybody even on the LP side, as a passive investor that has at least 20% ownership in the overall project, the lender will typically require you to be underwritten with the loan. But those levels are changing based on the lender. So some lenders, it might be 20%, but I've seen some lenders do it down to 10%. So you have to constantly be asking the lender, what is that threshold that you want to see? And so it is possible that if that's why when you see some projects that go out and there's various offerings, you will see them say that the minimum investment is X, the maximum investment is X, because they want to make sure that you don't get over that amount to be able to have to be underwritten with the loan, without actually telling you that, hey, you do have to be underwritten with that loan. Let's see, Tate's asking, how much skin in the game do the loan guarantors, or do the lenders want to see for those loan guarantors? It varies on the lender. So they just usually want to see some sort of skin in the game. They don't usually have a number. But one of the things that they do like to see is that if that loan guarantor is getting any portion of the acquisition fees or a loan guarantor fee or anything like that, they want to see that their skin is actually over and above that fee amount, so that they know that they're not just putting in their loan guarantor fee into the project. Next question is 20% of the project or 20% of the equity raise? It would be 20% of the overall project. So if you actually have an investor who is on both sides, and like they're participating somehow in the general partnership, they're on the GP side as well as the LP side, it is the overall project. So you have to make sure that you are constantly monitoring that, and anybody who has over 20% is required to do that, because it's not necessarily just 20% of the equity raise, because if you do 20% of the equity raise, it is not actually 20% of the overall deal, because their ownership percentage is based on the equity splits that you have with the investor and the GP side. So you have to figure that out on a case-by-case basis to know what that maximum investment amount is. Mark is asking the question, can guarantors use their PFS or net worth / liquidity over and over on several deals? The answer to that question is yes, you can. So it is not, this net worth requirement and liquidity requirement on a deal by deal basis. So it's not like if you have a $50 million net worth, you can only sign on $10 million deals and that's it. I actually, this is one of the first questions that I had when I started looking into doing loan guarantor work, is I reached out to one of our brokers and from the lending side and said, hey, what are you seeing here? Are we able to do this? And he said, oh yeah. He goes, it's deal by deal. He said, I have a guy right now. He's got a $35 million net worth and he's signed on over $500 million in deals. And so you can do that. I will say that certain lenders will get a little bit squeamish when you start to do too many deals at a certain velocity. I have seen that as well. But it doesn't necessarily prevent you from being one. They might just ask you to bring on an extra person to be able to have that additional guarantee for them as well. Harris is asking a question. So if you have the liquidity and invest into a deal, a lot of the liquidity, then how can it be in an ongoing liquidity check if you use the money into the deal? You're correct, Harris. So you have to have, after the deal closes and you've invested what you want to invest in a deal, you have to have that liquidity check after you close on the deal. So it's an ongoing requirement that you have to have. So it is a little bit of a challenge to be able to maintain that liquidity, which is why a lot of people will have a outside loan guarantor that they actually compensate, which is what we're talking about today, to be able to help them with that. James is asking here, are these recourse or non-recourse loans? So most of this that we're talking about is going to be for non-recourse loans, but I have seen some recourse lenders requiring some of these things as well. Anthony is asking another question. Can the loan guarantor be an LLC, trust, et cetera, or does it have to be a human being? No, it can be a LLC or a trust, but they just have to meet those same requirements of net worth and liquidity. All right, so yes, Ben, we will be talking about the specific risks to the loan sponsor specifically, so we'll cover that in just a minute. And then Charlie's asking, just for clarification, will an investor with 20% or more of the total equity in the project be required to guarantee the loan? Yes, that is correct. So they are required to be underwritten with the loan and be a guarantor on the loan as well. So there might be some exceptions depending on the lender where you are able to do it without actually being a guarantor, but they will still be required typically to be underwritten with the loan as well. So that usually means they got to be a loan guarantor. But depending on the strength of your team, they might not need that. So it just depends. All right, so let's move over here to the next question here. What is the role of the loan guarantor on a deal? So obviously the role of a loan guarantor is going to be, to be able to provide some of these deficiencies that you have yourself as you're trying to actively put together these projects. And so they're going to be able to come in there and help you meet that net worth and liquidity. And one of the biggest benefits for a guarantor that has a high net worth, we're talking, 20, 30, $40 million, is that they're actually able to sometimes get you better terms with the lender as well, because they have lower risk of the deal because they have a higher net worth person sign on the debt. And so if they have that higher net worth person on the loan, then instead of getting a higher interest rate loan, they can sometimes save you on the loan as far as the interest rate, but it can also help you from the terms, from how many years of interest only you have and various things like that. So that's one of the most important things when you're selecting, that next question or the second question from this one we're covering, how to select the right loan guarantor. This one right here. You got to make sure that you find somebody that has a really high net worth. You would be better off to find one loan guarantor to help you with your entire project than trying to find 4 or 5 of them that can only meet. So let's say you're doing a $20 million deal. You don't want to have $4 or $5 million guys. You'd be better off to have one person with a $40 or $50 million net worth than having to piecemeal it up. So it's a lot more work for the lender to do it when there's multiple loan guarantors, and a lot more paperwork. And so there's a lot more legal fees. And then it also can sometimes change the terms of the offer of the loan as well. Let's see. Where to find a loan guarantor. So obviously, I'll give you a couple of free ways to find a loan guarantor, and of course, I'll tell you a way that I can actually help you with that. So one thing is where to find a loan guarantor. One of the best ways to find a loan guarantor is to get out to events and start to network with people and start to talk with people, because I will tell you that, for me, when I do loan guarantor work, I will not loan guarantor with somebody unless I have a prior existing relationship with them. I want to make sure I know who they are before I start to sign my name on it. And this kind of goes back into, what Ben had asked earlier. Can you talk about the risks to the loan sponsor? Because even on a non-recourse loan, which means there is no quote unquote personal guarantee, there are still a lot of personal risks that go involved with that, where if for some reason that sponsor, that operator does not operate that property the way it should be handled, and for some reason you default on that loan, they will come after you and for that, because they'll try to see, is there any type of part of those bad boy carve-outs where they can actually convert it from non-recourse to recourse. So if they see any fraud or embezzlement or, misappropriation of the funds within the property, they can convert that from a non-recourse to a recourse debt. And if they find that you misrepresented your net worth and liquidity on your PFS, they can also use that as a trigger to make it go from non-recourse to recourse. And then I would say the number one reason why I'm a very strict person when it comes to doing loan guarantor work. I don't do it a lot right now. I do it on a very select basis. I have to know somebody for quite some time before I actually do it, is because at the end of the day, if the deal does go south, guess who's going to be the one in the newspaper that basically talks about you being the slumlord, right? It's not going to be the operator that had the lower net worth. It's going to be the person on that operator's team who was the loan guarantor, who had the highest net worth, and they're the ones that are going to be on the headlines. And I've seen this, so I'm not just hypothesizing this. I've seen some large syndicator actually be a loan guarantor on a property, and they actually have headlines right now in the news. It was a couple of years ago, but they had headlines in the news about how they were a slumlord. And they actually, I've talked to them, and they had no, they didn't have any, hand in the operations, which was their fault for not monitoring it and being a part of it. But their name and their reputation was one that was on the line. So, you have to, the loan guarantor has to balance the risk of their reputation, which to me, at the end of the day, my reputation is worth more than anything. Nobody can pay me any amount of money for my reputation, because it's the number one thing that is an asset or something that I cannot, be compensated for. Right. So if I'm very strict on who I actually do that for because of that. Next question here is how to select the right loan guarantor for your deal. So we kind of talked about that a little bit. So let's talk about the compensation for a loan guarantor. So how do you properly compensate a loan guarantor? So there's two main ways that you can compensate a loan guarantor, and I actually prefer both of these on a project that I would be a part of. The first thing is, which is the most common, is an equity split on the GP side. So if you have a deal, that's 70% of the deals for investors, 30% of it's for the general partnership, and that 30% of that GP, you would give them 10 to 15% of that GP to be the loan guarantor. And I've actually seen it higher than that. I've seen it about 20, 30, 40%. The 40% is probably the highest I've seen, which I think is a really high and kind of outrageous, but it really depends on the loan guarantor and depends on the risk that they have in that deal. So lower end C-class properties, especially even your D-class properties, are going to have a whole lot higher risk for them, and they're going to have a whole lot more oversight in it. So they might actually request more percentage on the GP side for that. And so there's usually an equity percentage that ranges typically between 10 to 20%. And then the second thing is a loan guarantor fee that is usually between 1 to 2%, depending on the size of the deal. So it can also see it go up to like 3 or 4%, just if it's like a smaller deal, just to make it worth it for that loan guarantor to be a part of that project. Now, so those are the two main fees that you would actually compensate them with. And so you have to make sure that when you're doing your underwriting, you include those fees in it to make sure that the deal will actually work with it. So let's go over a couple of these questions here. We have about probably 5 or 10 more minutes, and I see a lot of questions coming in, which is great. I love questions. So if you have any questions, go ahead and type them in, and I'll start to answer them. So far, let me get a pulse on everybody. How's everybody doing? Has this been good content? Are you enjoying this webinar? Are you enjoying the content? Just raise your hand or type into the chat box. Let me know if you're learning something today. So if you learned something today, I'm going to lower everybody's hands. If you learned something already on the webinar, I want you to raise your hand or type some information into the chat box so I know. Great. Awesome. Thank you, Carlos. Thank you, Perry. Thank you, Lorelei and Brent. I got Brian on there, Gary, and look, a bunch of people raising their hands. So that's awesome. I love being able to help you guys out, because I know a lot of times we kind of put these kind of answers behind a paywall, and we don't want to do that. But one thing I did want to mention to you is when we talk about where to find a loan guarantor, that's one of the reasons why I created the Multifamily Investor Nation Premium membership. So inside of this premium membership, one of the bonuses and benefits that you get is we have a section in there that allows you to be able to have a list. Right now we have a list of about 7 or 8 loan guarantors that are on that list. And so if you're on here right now and you want to be added to that list, reach out to me, send me an email, let me know. Be glad to be able to add you to that list after we have a conversation and I vet you a little bit. I want to make sure I'm presenting loan guarantors that I am confident in. But then if you are interested in finding some of those those loan guarantors and starting to build relationships with them, you can go to mfinpremium.com. I'll type this up here for those of you who are watching online. You can go to mfinpremium.com. Or for those of you who are on the webinar right now, I'll type it into the chat box. And we have a membership program that is behind a paywall. So we do right now have a free trial on it. And we also, the monthly membership is only $99 a month after the free trial. So if you want to check that out, you can do that. And love to have you part of that. So let's answer some of these questions here towards the end. So next question here coming in, I answered Ben's question on here. Next question is from Joel. Joel, if I'm a loan guarantor on a non-recourse loan, will that affect my personal credit qualification or credit rating? So it should not, as long as the deal is not going south, right? So the deal goes south and they have to default on it, even though they might not affect you from a guarantee and not coming after you because it's non-recourse. It could potentially affect your credit score, your credit rating, because that would still be on there as a mark. And so that's, again, additional thing that you got to keep in mind. And not only that, if you are on a property and a loan and you default on it, then you could actually be blacklisted from Fannie Mae or Freddie Mac and even a lot of these bridge lenders from being able to get another loan. What is the risk as guarantor with non-recourse debts? We talked about that. As a loan guarantor yourself, what tangible, intangible must-haves you want to see in the operator before you will partner with them? How do you underwrite them? So, I mean, obviously, as a loan guarantor, one of the number one things that I'm looking for is that they have enough but I have enough extra. The DSCR is high enough that is at least, again, a lot of times the lenders are doing all of this stuff for us, Mark. So we don't have to do a lot of this underwriting, but as just a loan guarantor, right? All I really care about is, can the debt be paid, right? And so as long as the debt can be paid, that's kind of what the lender wants to know, right? So the lender's going to make sure, because they're the largest investor in the property. They're not really an investor, but they have the largest amount of money in the deal. They want to make sure that their debt is going to get paid. And so they're going to make sure you have that minimum DSCR, typically 1.25 or above, depending on the loan. And so we want to make sure that that debt is being paid. There's two really main things that I want to see in an operator for myself before I would actually partner with them as a loan guarantor. Number one, I want to see that they're full-time in the business. I don't want anybody who's doing nights and weekends and trying to quit their corporate job. That's all great. I'm very supportive of that, but not when it comes to being a main operator on a deal. That type of person needs to be somebody who is still part of the GP, but they're not the main person putting that GP together. They still have some roles and responsibilities, but the main operator must be full-time in the business and be all in, because I want full-time efforts on my money if I'm investing in that deal, but also if I'm an underwriter, I'm a loan guarantor on that as well. The second thing that I look for is I want to make sure they have somebody on the operations team must have some form of background and successful background in in business in general. So it doesn't have to be multifamily, but it has to be business in general. So I want to make sure that they have that success, because at the end of the day, we're buying businesses. We're buying businesses that just so happen to have real estate associated with it. But when we're buying these businesses, you have to know how to manage people. You have to know how to put in systems and procedures and processes in place to make sure that your deal is not going to go south. So those are the two main things that I look for, Mark. Brian is asking, is the loan guarantor usually on the GP or LP side, or both? So they don't have to be on both, but obviously they're always going to be on the GP side, because most loan guarantors, the reason why they're doing that is to be able to be on the GP side and have that extra income from it. But the loan guarantor, if the lender requires them to invest in it, or they do actually invest in it, then they'll actually be and have a position on the LP side as well. So good question there as well. Harris is asking, how much was the loan guarantor fee? So the loan guarantor fee is based off of the loan balance, and so it's typically anywhere between 1 to 2, maybe 3%, depending on the size of the deal. Mark is asking, when there are several aggregate guarantors, do they all split the same 10 to 15% of the GP? So the answer to that question is Sometimes. So if, let's just say, there's a couple of different partners and you're all, you're going to share in that loan guarantor piece, you might not carve that out for it to be a 10 to 15% piece of it, because you're just going to all split it anyway, right? But if you have maybe say 2 or 3 partners and you have to bring on an outside person, then that's when that 10 to 15% carve out for that loan guarantor would come into play. But if you have to have 2 different outside carve outs for those loan guarantors, then yes, Mark, you would actually split that 10 to 15% with that person, and they might both want 10%. So that's why you might have to go up to 20%. But you can't do the deal without these loan guarantors. So that's why a lot of people will still give them a little bit higher percentage just so they can get that deal done. Roger's asking the question, could you just go over the guarantor compensation again? 10 to 20% of what? And that's of that loan balance. And then 1 to 2%, sometimes 3% of what? And that's of the loan balance. So it's all based off the loan balance because that's where the risk is. So good question there, Roger. So Joel, I already answered his question here. Raj is asking, is guarantor's entire net worth at risk, or can a guarantor shield some of their assets? No, not really. So as a guarantor, your entire, net worth is at risk. Obviously, one of the nice things about being a known guarantor in multifamily is that, just like as if you were invested in it, there's a lot of downside protection with it. And so that's why a lot of these lenders do non-recourse debt, because they're okay with doing non-recourse debt because they know that if the deal does go south, they can take it back and sell it and still have a great win. Do lenders require the 10 to 30% loan to purchase cost or LTV? So the 10 to 30% loan to purchase or cost. So Rick, I think you're asking, what kind of loan to cost or loan to value ratios are they typically looking at? When it's non-recourse debt, it's typically, if it's Fannie Mae or Freddie Mac, it's going to be probably, 20 to 30%. So your loan to value is going to be, 70 to 80%. Right? That the lender is going to bring to the table for you. When you get into the bridge debt, they can be a little bit more aggressive and get you a little bit more than that. What we do internally for our team to make sure that we are staying conservative is, if we do agency debt, we try to be around 71, 72% loan to value. When we do a bridge loan, it's usually loan to cost. So we're doing more, 78, 79%. We try not to go over 80% if we can, because that's when it gets too risky. And that's also when a lot of properties back in the last recession lost their properties. Trisha is asking a question. What are the other ways to find a loan guarantor outside of events? Well, you can go to the MFIN Premium and find one there. Go to mfinpremium.com and sign up for our membership there. And you can find, there's a list there of all those loan guarantors. But even outside of that, you can also ask your real estate attorney. A lot of times they have connections, or you can ask your brokers, whether it be a debt broker, whether it's the person who's actually providing you with the loan, the lender who's brokering it for you, or even a multifamily broker themselves. They can also find and have connections with those people. And then also another kind of strategy is to talk to property management companies, because they're dealing with these high net worth people all the time. They might not always be ones that will do it, but they will. They can provide you some information, because they're contacting these owners all the time and giving them updates on their properties. John's asking, can you elaborate on the fit of the LP with the team? Heard some want someone to be an asset manager, high involvement with the operator. So some lenders do want to have some more involvement. So it just depends on the lender. So, I've seen some where they can be completely passive. They don't have to do anything. But it's I think it's kind of foolish as a loan guarantor to do that. So I would prefer to have the loan guarantor provided some additional services or responsibilities. But if they do some additional services or responsibilities, they're going to want more than 10 to 15%. They're going to probably want more like 25 or 30%, or depending on what the split is on the responsibility. So you will have to give up more the more responsibilities you give that loan guarantor. George is asking, will you give us an example in dollar amounts on how the compensation for a loan guarantor would work? Well, to give you a quick example is, if you had a $12 million deal, you had a $10 million loan balance, you give them a 1% loan guarantor fee. It's off the loan balance itself. So 1% of a 10 million is going to be $100,000. So they'll get $100,000 the day you close that property. So hopefully that answers your question, George. If it didn't, let me know and I can clarify a little bit more. Should a loan guarantor provide a POF? I have never been asked to provide a POF. Except for from the lender itself, because they're going to require that. But most lenders don't usually require you to provide a POF up front. And I would never provide a POF maybe not never, but I don't think it's necessary to provide a POF as a loan guarantor to somebody who is an active sponsor. It's just, I just have never seen that. So I would say no, I would not require that for somebody. Scott's asking, although these loans are non-recourse, if a GP and or guarantor acts in bad faith, fraud, etc., triggers bad power carve-outs, then can the lender go after the loan guarantor's assets? The answer to that question is an absolute yes. So it can be converted from a non-recourse to recourse due to those bad boy carve-outs. So Brian's question is here, I own the dominant apartment locator service in Birmingham, Alabama. We have decided to open an investing arm of the company with a solid management company as GP. The neighborhoods I don't have the rest of that question there, Brian. So I'll have to have you retype that out or something because I don't actually see. Oh, there it is. It's down there. We are looking into have C properties that are becoming B. The reason we are looking into loan guarantors is that we would have to buy several properties to make the strategy work. Would you advise working with local loan guarantors only, or open it to other people who would be strangers? Well, I mean, I think you have to ask yourself that internally if that's a good question. I mean, a good strategy or not. But if I was in your situation, I think depending on how much you need from a net worth standpoint, I would certainly try to do it locally in that situation for you, Brian, before trying to open it up to other people. But sometimes you might not be able to fit that with other people with what you're looking for. So you might have to go out. So you just have to make sure that you build those relationships. One of the worst things you can do is find a deal, put it under contract, and then go call a loan guarantor and say, hey, we're closing in next week. We need a loan guarantor. They're not going to be happy. They want to have that additional time of doing their own due diligence and getting to know you beforehand, which is why I tell all of our MFI and premium members that go build relationships with these loan guarantors now before you have a deal. And that way they can get to know you beforehand, and don't just the first time they hear from you, it's when you need that. So Tate is asking, just to be clear, though, the guarantor typically gets 10 to 15% of the loan balance, not the GP. No. So the 10 to 15% is not of the loan balance. They get 10 to 15% of the GP. So the loan balance portion was of the percentage that you're giving to them as a loan guarantor fee. So it's similar to like an acquisition fee where you'd get a 1 to 3% acquisition fee, and that's actually usually based off of the overall total deal. Well, the loan guarantor fee is based off of the loan balance, and that they would be getting a percentage of the loan balance as their upfront fee instead of that acquisition fee. So hopefully that clarified it for you there, Tate. So Casey's asking another question. I think maybe you just overlapped a bit from what you previously said. The 10 to 15% is of the GP, not of the loan balance. That's correct. So I might have misstated that. That's why a couple of you were asking that. So you are correct. So the 10 to 15% is on the GP, not of the overall loan balance. That would really be nice, though. If you're doing a $10 million deal and you get a nice $1 to $1.5 million check, that'd be nice, right? But no, that's not correct. So I'm glad you guys brought that up so I can clarify that. So the fee for the 1 to 3% is of the loan balance. I apologize. All right. Charlie's asking a question. If a loan has multiple guarantors, then the guarantors and the borrower are each typically jointly and severally liable to the lender. This means that the lender can go against all or any one of the guarantors. So do you typically see some type of agreement among the guarantors whereby they agree to be responsible for their pro rata share of any amount recovered by the lender from any other guarantor? Example, if there were 4 guarantors, then each guarantor would agree to be responsible for 25% of any amount recovered by the lender from another guarantor. So I have not actually seen these kind of side agreements, Charlie. I presume that they do it based on your ownership in the actual entity itself. But obviously, if you're the loan guarantor and there's other people, then it is possible they can come after you as well for the full amount. So they're going to go after as many people as they can to be able to get their debt paid. So it's definitely something you got to be careful of, and make sure that you have people on your team that kind of have that higher net worth as well. George is asking here, I'm also interested in how the equity portion of the GP transfers to a dollar amount example. That's a little bit hard to kind of quantify because it depends on the deal. But to give you an example, it's just really quickly, if you bought that $12 million deal, you had a 10% loan balance, a $10 million loan balance, and you have just say 10% of the deal. Well, let's say they were able to sell that deal, 5 years later for, let's say 20 million, and you got $8 million profit. Well, obviously the percentage of the overall deal is going to depend on the equity percentage that you as the GP have from your investors. So if you have a 70-30 split, then you're say 10%, you would take that 10% and multiply it by 0.3. and that would give you your overall involvement in the deal, which is actually 3%. And so you take that 3% and multiply and take the $8 million profit that you had, and you take that $8 million and then the $3% of that $8 million, and your profit on that would be $240,000 if it appreciated over 5 years to that $240,000. Now, that only includes the sale proceeds at the end. So there's obviously going to be some share of the cash flows while you're in the deal. Depends on how the deal is structured. So it's a lot of different details and moving parts on that one. So I can't answer that specifically. Last question here is from Scott. Does a loan guarantor typically get the same percentage of the acquisition fee, ongoing GP distributions, and sale proceeds? So the answer to that question is yes, on the ongoing GP distributions and sale proceeds, but typically the acquisition fee, since they're already getting a loan guarantor fee, they might not also share in the acquisition fee, but it just depends on how you have it set up. I've seen it done a couple of different ways. So a lot of this is just kind of specific to how you want to structure it when you're finding that loan guarantor. All right, let's see. Lorelei is asking here. I actually have a couple of questions that came in as I was switching over. At what point will you no longer need a loan guarantor? Whenever you have whenever you have the net worth and liquidity and experience to be able to do it on your own, that's when you won't need them anymore. But you'll have to keep them on the loan for the duration of that loan. So good question there. Does the loan guarantor have to bring any money into the deal? It depends on the lender. So we answered this a little bit earlier, but the loan guarantor doesn't necessarily have to, but sometimes the lender will require it. So you just have to kind of ask the lender to make sure. And Mark is asking, have you ever seen where a lender required the loan guarantor KP to have more voting rights in the operating agreement than other GP members? In other words, the KP can unilaterally make property and business decisions. No, I have not necessarily seen that from the lender's side of things, but as a loan guarantor, it is actually a smart idea to work with your attorney to have a side agreement or something in the operating agreement that basically states that if certain KPIs or certain key performance indicators are not met in certain metrics, then it could actually trigger the loan guarantor to take over the deal. That doesn't allow them to get more equity percentage per se, but allows them to take over and make those decisions on the property to make sure that the deal doesn't go south, since they are the loan guarantor on it. So last question coming in here from Avia is, or just as the guarantor, they get 10 to 50% of the guarantor fee, everything for free. So probably for just signing as the loan guarantor, they get 10 to 50% of the GP and the guarantor fee, everything for free. Well, I mean, it's not necessarily free, because if you have to understand how much they had to do to get to that point in their life where they actually had that net worth and liquidity, it wasn't free by any means. And they are also risking a lot of things, their reputation, their net worth. They're putting a lot of faith in you to operate that deal. So there is a lot of risk. And so what you're paying for is risk that they actually have in that deal. And it took a long time, a lot of work for that person to get to the point where they had that net worth and liquidity to be able to get to that point. So you might think it's just for doing nothing, but it took a lot to get to that point to be able to be that loan guarantor. So I would say it's not free at all, which is why they're having to pay for that. And one of the reasons why I'm a little bit more strict on it is that I don't think it's enough to pay me to be able to be a loan guarantor on deals, because it's not worth risking my entire net worth and liquidity and my relationship with my wife and things like that and family, because you had a deal that went south, and then they're coming after all my assets because you had a deal that went south. So it's really the risk that's involved with it that really is what you're paying for. So all right. So how'd you guys like that webinar? Raise your hand. Tell me in the chat box. What'd you think? Did you have a good time during this? And did you learn something today? That's the important thing is when you come to these webinars, did you learn something? Because you don't want to just keep on coming to these webinars not learning. You want to be constantly learning and expanding your knowledge. And hopefully, these weekly webinars that we do are important for you and that you continue to participate with them. So I'm going to refresh the screen here and see if this is going to work. It does. So, all right. So I have Melissa on the back end. You kind of saw her last week, I believe. But we have the next webinar that is available for you to register. So I'm going to click on this link here and just type it into the chat box so you can register for the next webinar that we have coming up. So it is going to be building your apartment syndication brand. And so Melissa Broom, our director of marketing and public relations, is going to be on the webinar with you next week to talk about helping you build your brand with apartment syndication. So we're going to be covering, what does it mean to have a brand? Why is having a brand important? What are the beginning steps to building a brand, strategies to building an online presence, advanced brand building strategies to enhance your brand. So all of these topics will be covered next week. And I believe it's actually going to be on Monday. So yes, right there on the screen there, it's Monday, February 17th at 12 p.m. Eastern. For those of you who are watching the recording, so this is going to be recorded, or this has been recorded, you can go to multifamilyinvestornation.com/MFIN webinar, all one word, no spaces or dashes, and be a part of that. So, but right now, take the time, if you're on here right now, take the time to go to MFIN Premium, sign up for that free premium membership. I promise you won't regret it. And I put my own personal guarantee myself on that program. And just like you find a lot of benefit and value through these webinars, there's a lot of exclusive things we do only to that premium group that you'll be able to benefit from as well. So thank you guys so much for being here. Looking forward to having you on the next webinar. And until then, hope you have a wonderful day.